Everybody, I am doing some portfolio moves right now. I've looked and checked to see what my biggest positions are at the moment. They've changed in the past few months, and I've been doing some buying in my portfolio. It's getting to where I'm putting some, I'm contributing aggressively to my retirement accounts at this time of year, for example. So I'm putting some money to work. I've been buying one of my largest positions, even more of. Before we dive in, please take a minute and click subscribe to my channel if you don't already. And check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. So let me go ahead and share my screen real quick. All right, so these are in order my five largest stock positions right now. Number one is Realty Income, ticker symbol is O. They are a real estate investment trust. They own about a little over 15,000 properties. Mostly are occupied by single tenants in the retail space. You see there's someone walking around a drugstore. Walgreens and CVS are both Realty Income tenants. All the dollar store companies are. They have fitness centers, restaurants, all kinds of businesses occupy these properties. Generally beaten down because of interest rates right now. That's the stat on the top tells it all. Despite roughly 20% earnings growth since the beginning of 2020, the stock is about 35% below where it was before the COVID pandemic started. That's when it had its all-time high. It's rebounded since then, but then it took another dive because of interest rates. And now it has a 5.8% dividend yield. It pays dividends in monthly installments. And it actually has a trademark on the phrase the monthly dividend company. This company still has a lot of market opportunity. 15,000 properties sounds like a ton, and it is. But there is a multi-trillion-dollar marketplace of these type of properties. A lot of them are owned by single tenant landlords or single property landlords. Excuse me. A lot of them are owned by the businesses that occupy them. There's just a lot of room to grow this business even further over the years. It's the first real estate stock I ever bought, and I've been buying shares for over a decade now. Number two, this is one I added to in January quite a bit. General Motors, GM, I added significantly when there were a lot of tariff concerns that made the stock drop. I thought that was a great buying opportunity. Getting rid of the robo-taxi business they were trying to develop through Cruise is a near-term positive for profitability. They were spending $1 billion a year on it, and just figured it could be better spent just trying to maximize the autonomous technology in their driver vehicles. Falling rates could be a big tailwind for GM in 2025 and for the next few years. High interest rates have prevented a lot of people from wanting to get auto loans, so that could be a big positive. It's also been preventing companies like GM from offering promotional financing to the extent that they used to. When people could go get an auto loan for 3 or 4% interest, it wasn't that much, for an automotive finance company to offer 0% interest. But when the going rate for auto loans is about 10%, like it is right now, it's a lot more of a stretch to bring buyers in. And as far for everyone but Tesla, GM has probably the best progress on EVs so far. I love a lot of what they're doing, with their brands and maximizing their most popular brands, but still kind of sticking to their traditional vehicles as well. I think they're striking a great balance. So GM is my number two investment by dollars right now. I always get a lot of pushback for that one, so I'm ready for it. Number three is Mercadolibre. This was my number one investment in the fall, but it's down about 17% since then. Down about 17% from the high. But there is a lot of potential. I'm really curious to see their earnings in the next few weeks. A lot of potential in this business. Some concerns. Their profitability was weak in their third quarter earnings, which is why the stock is down 17%. They have a lot of exposure to some not so stable markets like Argentina, and the credit portfolio that's been growing very fast is a good and a bad thing. It's a high interest, high margin business, but it's also a higher risk business than they've been in the past. So really, just I'm more in wait and see mode with this one. So spoiler alert: this is probably not the one I will be adding to in February. Number four is Pinterest. PINS, will see their earnings shortly on February 6th. Pinterest is down almost 30% from its 52-week high. Despite the strong progress its new management team's made, CEO Bill Reddy, who is a former Google executive, took over a little over a year ago, I believe, and has done a great job of really just leaning into the e-commerce part of the e-commerce connections of Pinterest business. A lot of progress that's still to be made overseas, especially. They're not doing a great job of monetizing their international users yet, but it's getting better. So I still think Pinterest has a lot of room to run. My favorite social media stock by far. And it's one that I bought at the depths of the COVID crash as just kind of a value play, and I like the progress of the business ever since. So I'm not getting rid of it. And number 5, rounding out my top 5, is Berkshire Hathaway. I can make the case very easily to make Berkshire my number 1 investment, especially now. I've been buying shares since 2014. It's one of my top investments. It has been my biggest investment at certain points. But of my top 5, I would not necessarily call it the most expensive, but it's definitely not trading at a discount. It's the closest to its all-time high, just about 6% off of it. It had the reason I say now I can make a really good case for it. Berkshire has $325 billion of cash on its balance sheet, probably more actually when we see its latest earnings in a couple weeks. That gives it a big advantage in turbulent markets. If we see a market crash in 2025, that's unmatched financial flexibility to either make acquisitions or buy stocks at cheap valuations. So Berkshire is one of my favorites. But having said that, let me go ahead and stop sharing my screen. I do think the one that I generally, one of my big investment predictions for 2025, and this is just my prediction, I could be wrong, is that interest rates are going to fall more than the market seems to think they are. The latest expectation is for 1 or 2 Federal Reserve interest rate cuts this year. I think we're going to see 3 or 4. I think that there's not just because there's now political pressure for the Fed to cut rates, but I think that inflation is going to continue to gravitate toward the Fed's target. I think economic data might get a little turbulent, and that might prompt the Fed to cut a little more aggressively. But generally, I think interest rates are going to fall. So the one that I think is the best of these 5 to add to right now in February is probably Realty Income. I plan to buy some more shares in February of that one. Again, it is my largest investment, so that kind of tells you how confident I am about this one over the long run. And I just think right now looks like an excellent entry point. Which of these 5 would you add to? Please leave me a comment on this video. I'll do my best to answer every comment or question individually. And thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.